Okay, I guess let's call the meeting to order.
I'll do our roll call. Good morning.
Morning.
Landon Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly,
Here.
Karen Savage, Mary Smith, Mimi Terry, Derek Challenger,
Here.
Gloria Taylor,
Here.
Flora Barisha,
Here.
Gregory Coleman,
Here.
Tom Shanley, John Morrison,
You know that
Here.
Gloria's sitting down.
Brian Birnbaum, Jim Whitney.
No, seriously.
All right, first agenda item is just approval of the minutes from the prior meeting in November. Does anyone have any questions, comments, edits?
Do we have a quorum to approve?
No. No.
We do not have a quorum.
So we're waiting on,
Yes, Stephanie
Stephanie.
Elliott Williams, she was going to sign in.
okay, well, if Stephanie does sign in, then we'll come back to the minutes. So next, Ms. Barisha on the OPEB benefits.
Good morning again. So we presented November statement for OPEB because December one is not officially issued yet. But also I provided this morning a statement as up to yesterday, which is January 31st, 2024, for OPEB funds in our accounts. So far as up to November 30th, we have 8.5 million, almost 8.6 million. Given the circumstances, this quarter has been doing pretty well compared to September, where it was 8.3 million. So as up to November 30th, an realized gain for the whole year, I mean, all losses has been washed, and it is $40,000. And if you see today's screenshot that I gave you, it looks like as up to January 31st, 2024, we have 8.9 million, which means that this month during December and January has been doing pretty well. So this is something that we don't handle investment, is the portfolio is handled by the account holders, I mean the investing company. But if you have any question, I can give you an answer. And just to mention, we're projected to make a payment for fiscal year 2024, 1.5 million as a contribution to this OPEB account, and it's going to be $1 million from general fund and 500 from proprietary funds, practically from public utility. If you have any question, I'll be happy to answer.
None from me.
Good.
Thank you.
You're welcome.
Next up, we have Greystone. Hello, Brian.
Landon,
Hopefully you can hear.
That's still applicable now that we're in February, but apologies that Jim and I can't be there in person, but we look forward to seeing everybody. I guess it's in May will be the next meeting. We were intending to have a special guest with us. Jim, I don't know if Dan was able to log in or not.
No, I've been working on it this morning. I think the link was blocked by Morgan Stanley, so he's struggling to join. Brian and I have joined through our home computers. But we'll keep pressing ahead. Why don't you do the review of the quarter, and then we'll see if
Okay. Tom, if you can just go to the next slide.
Yeah, it's not me. I think Stacy might be running it.
Oh, sorry, Stacy, if you can go to the next slide.
Sorry.
That's all right.
That should be slide 2. I don't know if these are out
Why
of
is it
order or
up?
not.
Just
Can you
one
go back?
second,
There we
I'm
go.
so
Keep going.
Not today.
Sorry.
I'm so sorry.
Forward.
I'm gonna get this working here. I'm so sorry. I'm gonna try it one more time, okay?
Okay.
Why is it acting up today? Okay, we're gonna get it. We're gonna share screen one more time. Let me see.
And that Friday before.
Okay.
You never know.
Yes.
All right.
All right, I'm gonna try this one more time. I'm so sorry.
No worries.
I'm not sure what's going on. Okay, let me do this. Let me do something different. Okay, just 1 second. So sorry. We're gonna get this right.
Maybe all these challenges we're having on technology says something about the valuation of these companies.
I know. Oh goodness. All right, we're getting there. We're getting there. Oh my goodness. Oh wow. No, I should. No. I'm so sorry. Why is it acting up? Oh goodness. Okay. Oh goodness. I'm so sorry.
Okay.
Brian, you're doing a good
Well,
job
maybe
so
I'll
far.
I'm so sorry. This is so crazy.
Any questions? Maybe as Stacy's trying to bring up the slides, I recognize that you don't have copies in front of you, but maybe I'll just kind of start with some broad comments, and hopefully we can get the slides up there so we have something to look at.
Okay, yes. Okay.
Look, the fourth quarter
This right there, okay.
was
And
quite
then do
strong
share screen.
across all
Cancel.
capital
Share
markets.
screen, and then go here.
Both
What's happening?
here in the
it's
United
going
States
from
on the equity side,
browser versus
overseas, even emerging markets were quite strong in the fourth quarter.
On the hard drive. I'm
And
having problems
so for
with
the
the
full
browser.
year, it turned out
And
to
I-
be quite a good one.
Let's see.
Looks like we might. No. It turned out to be quite a good one, particularly on the heels of what 2022 looked like, right? We'll recall, not that anybody wants to relive 22, but rapidly rising interest rates, inflation levels that we hadn't seen in 40 or 50 years, double-digit negative returns across global equity markets, a bond market return that was the worst in the history of the bond market. So 2023 happened to be the mirror image of what 2022 was. And the reason, by and large, for that is because it was becoming increasingly clear that the Fed was getting a handle on inflation, not bringing it all the way down to the levels it likes to see, around 2%, but certainly a lot of progress made on the inflation front as a result of Fed interest rate hikes, fixing of the supply chain. All these things have resulted in inflation coming down to the point in the fourth quarter where the Fed met that we got sort of the pivot that we were all looking for. Maybe not so much the pivot, but clear direction from the Fed that they were on hold, and the next move was likely lower in terms of their monetary policy. We've got sort of a reiteration of that yesterday from the Fed, although they kept interest rates level, and it now becomes clear that the first interest rate cut probably isn't going to be in March, but maybe sometime in the middle of the year. It is clear that the Fed is going to be moving to cut interest rates at some point in 2024. So that view and that perception and that expectation really started to solidify in the fourth quarter. And that's why you saw such strong returns from equity markets in the fourth quarter. I'll just kind of give you some numbers here. The S&P was up over 11.5% just in the final 3 months of the year. The Russell 2000, which had underperformed the entire year, was up 14%. So we saw this in the fourth quarter, in addition to very strong equity markets, we saw this rotation into some of the areas of the market that didn't work as well as what we've talked about in the past, the Magnificent Seven stocks, these big cap technology companies that were driving pretty much all of the return during 2023. They still did well in the fourth quarter, but it was these other areas of the market that maybe hadn't generated as strong a returns in the early part of the year. Markets outside the United States were up about 10.5%. Developed markets, emerging markets were up about 8%, and even bonds were up almost 7% during the fourth quarter. Again, that puts us up for double-digit positive returns in 2023 across all major equity markets. positive returns on the bond market. So again, we've got this mirror image of, for 2023, what we experienced in 22. Now, when you combine the two together, we're basically flat over the year, but with all the angst and volatility that we saw in 22, it's good to see us sort of get through that and, for all intents and purposes, be flat over, one of the worst years the capital markets have experienced in 22. Doesn't seem like we're having much success on the slides getting pulled up, but maybe are there any questions about kind of what was going on in the quarter and
Brian, are you not
23 from a capital market perspective?
Brian, are you not able to see the slides? We're on slide 2, the capital markets performance.
I do not see that slide, so just strange. Jim, I don't know if you see it. But.
Tom, do you see it?
So it looks like we're seeing an image of the folder, the Microsoft folder.
Yeah.
I think that holds the document, so I'm not sure if maybe it's sharing a different screen than what you all are seeing, but
I might do
and that
is,
that just dropped.
I'm not sure what's going on today.
Well, if you all can see it, let me just pull up the doc on my computer here, just so I can reference what you're seeing. So, any other kind of questions or comments around that slide 2, the returns of the major capital markets?
And it looks like the screen, I can see it now.
All right, let me go back there. Give me a second.
Okay.
Yep, I can see it. Okay. But no questions about that. Maybe we can go forward a number of slides, just so we can start talking about performance. I think we got to go ahead like 15 slides or so.
Brian, I don't know if Dan's going to be able to join us, so maybe I'll just cover a few of these markets.
Do you want to cover some of this? Okay, I'll come back to the portfolio, but we'll have Jim cover some of these slides first.
Let's start on slide 7. Great, okay. So to begin with, we're still in this forecasting the soft landing camp, but there's going to be some significant volatility around that in our view. Rates are pretty close to their tactical fair value, and we do expect the Fed to begin cutting in May or June. We thought the consensus was out of line for a March cut, and Chairman Powell pretty much said this much yesterday. So where do we start? We have equity valuations that are rich, 20 times forward earnings. Consensus expectations, as we'll see in a minute, are pretty ambitious in our view. And we've got to get through a number of things this year. So we've got the economy, which is slowing, which will impact earnings. We have inflation decelerating, which is great. The market's forecasting a actual reacceleration in growth in the second half, forecasting 6 rate cuts, profit margin expansion, and year-over-year earnings growth of 10%. So that's how we fall into this Goldilocks camp. And I think history tells all of us who've been around the financial markets for quite some time that something typically goes wrong, these Goldilocks scenarios, they're just not sustainable. So the 6 or 7 points I just mentioned all have to come together to support current yields and current equity valuations. Underlying theme here, however, is the economy's pretty solid, right? We've got unemployment at 3.4, 3.5%. That's really solid. That's about a 50-year low. and that's really helping the economy move along. So our forecast is we've got a pretty wide range. We wouldn't be surprised to see the market trade between 4,100 and 5,100, just given all these variables that the market has to digest. So with that said, let's look at this slide 7, and I think the takeaway here is that 2023 was full of surprises, and the vast majority of them were about the robustness of economic growth, the resiliency of the economy, profits, in fact, proved almost insensitive to the 550 basis points of Fed tightening. And we'll review a few slides in a minute about the soft landing, but starting with elevated inflation, the soft landing scenario really has never taken place. So what we're looking at here at the top of slide 7 on the right is the S&P 500 PE ratio. That's the dark blue line. It's on the left axis. And you can see the Fed funds rate. So very close to zero for quite some time. And then the Fed started raising rates to about 5.25%, 5.3%. And the market was completely resilient. Brian just showed you the numbers for the U.S. markets, and multiple expansions rose during a sharply rising interest rate environment. Pretty rare for that to happen. Let's move to the next slide, please. So there were 7 stocks that did most of the heavy lifting. And what we're looking at here on the left in that purple line, that really is the Magnificent 7 stocks that you've been hearing about now for almost a year. Very, very strong performance. And what we're looking at here is the comparison to a bunch of indices, the traditional S&P 500 index, the NASDAQ composite, and then we have the S&P 500 equally weighted. Recall that the S&P 500 index is market cap weighted, so the bigger the company, the more impact it has on the price performance of that index. But now let's look at what actually drove these price changes. Were they multiple expansion, or were they really earnings based? So on the right side, we have the S&P 500 index up 24% for the year. NASDAQ up 43%, and of course the Magnificent 7 up over 75%. And if we move down to the second line, we look at the change in earnings for the trailing 12 months for these indices. S&P 500 index, earnings were negative, down a little over 2%. The good news is the Magnificent 7, those earnings were positive. They were up mid double digits, 17%. But when we look at the change in the multiple, and this is the price per unit of earnings investors are willing to pay, the multiple on the S&P expanded by 25%, and the multiple on the Magnificent 7 expanded over 50%. So 17% earnings growth for those 7 stocks, and a 50% increase in the price investors were willing to pay for those earnings. So if we move to the next slide, we can see that the Magnificent 7, now we move to the top 10, which includes those 7, of course. It's the highest level of concentration in 10 stocks in history. And the reason this is relevant is it does pose some risks that we have to factor in, and we look at the diversification of the portfolio outside of the S&P 500. As an example, what our exposure is to Europe, what our exposure is to smaller cap equities, and we'll cover that in just a few minutes. But the stocks in this cohort have one thing in common, and that's their correlations. So this group is, when interest rates move up, this cohort tends to trade down, very, very high correlation, and the reverse is true. And that's because in general, they're all pretty expensive. Let's move to slide 13. And I just want to highlight to the boxes here on the upper left. We have the S&P 500 index in the dark blue, and then we have the 12-month price forward price earnings ratio. And really what we're highlighting here is that at the current price of the S&P and the current valuation of nearly 20 times, we've created this gap, and the forward PE and the price of the S&P have been pretty narrow, pretty tightly correlated in the past. But this spike in the PE valuation that I showed you earlier has created this valuation gap, which makes stocks expensive relative to the forward earnings. And to the right, the VIX, it's also known as sort of the fear index. It's right around 13 as we speak. It's come down from 35 to 40 at one point in 2022, but just indicates that there's a lot of complacency built into the market. Let's move ahead to slide 17 for a moment. So this is the slide that I was referring to about when inflation is elevated, what happens to the S&P. So we've broken down history, looking at S&P 500 returns, post-cycle peak interest rates, the front end of the curve. And what we're looking at here is the average return for 3, 6, 9, 12 months when inflation is elevated at the start of the Fed easing, and when inflation is not elevated, meaning inflation had already come under control. This is a little hard to grasp because one could argue that inflation has already come in from 9% to 3%, whether you're looking at the consumer inflation or producer price index. But the point is that we started at an elevated inflation rate. The respective returns have historically been negative. Page 22. This is probably my one of my favorite slides because I think it sums everything up for us. At the upper left, left side, the very bottom, we're looking, that line is 2022 actual earnings. And the lighter blue line above it is 2023 earnings. And you probably recall us talking about the fact that we anticipated 2023 earnings to continue to decline, to be reset because of the pressure the Fed was putting on the economy. And we actually thought at the beginning of last year that those 2023 earnings would pierce 2022 and fall below when it was all said and done. So we got that part right. Those earnings came in pretty dramatically for 2023. I don't think they quite pierced 2023, but there was a pretty sharp decline in earnings. Ended up the year about 218, 219 for the S&P. Now, if we're looking at 2024, and these are consensus estimates, we're looking at about $243 for the index, and that's a pretty substantial bump. That's up 10% over 2023, and then of course that purple line at the top, that's 275. That's up about 13% over 2024. So if you take all of that information and you look to the upper right, and that's the S&P 500 index year-over-year EPS growth. Investors are maybe saying, look, we know that last year's earnings were going to be weak. That light blue line, it trended down all year. We expected that because investors knew that the Fed tightening would have an effect on the real economy. But what as investors, what we're looking out, what we're thinking about is, well, what's happening next? The stock market's a discounting mechanism. We're looking at 2024 and beyond. And you can see the dip in earnings, and the market's forecasting a 10% increase approximately for 2024 and 2025. Investors may be saying, hey, you know what? We just don't want to miss that. We're anticipating weak earnings, and this could explain the jump in the valuation that I showed you earlier in terms of what investors are willing to pay, not only for the Magnificent Seven, but for the broader market. Yet, and if we look at the most recent 3 months, the bottom right box, the 3-month earnings revisions are still negative, so down about 4%. Now we're very early in the first quarter of 2024, which is focused on the fourth quarter of last year. Earnings are just beginning. We saw one of the Magnificent Seven sort of fall off, and that was Tesla. Earnings were quite weak. We had Google yesterday, Microsoft yesterday. Google was below consensus. Microsoft was as expected. Okay, move to slide 28, and then I'll turn it back to Brian. So, U.S. fixed income markets, we think, could deliver solid single-digit returns, 6 to 8%, which can compete quite nicely with equities, in our view, for 2024. As the market trades in this range that I talked about earlier. Because there's a number of things that have to come into focus for equities to end the year on a higher note. So here on the right, we've just presented what we think that the term structure of rates will be as we march through the calendar year for both the 2, 5, 10, and 30 year. And that's the direction we think we're heading, and the markets are actually moving pretty quickly in that direction already. So I'll stop there. Again, I'm sorry we had a member of our Global Investment Committee to join us. That was our expectation to kick off the year with somebody from that committee, and maybe we'll try and reschedule. But I'll take any questions that you might have.
Jim, if I understood you correctly, based on history, and history is kind of in the past now, that you're thinking that 24 is going to be a decent year on the fixed side or the equity side?
We think we have a higher degree of confidence that the market, but the bond market, the fixed side, will deliver solid returns for investors. We could end the year in a positive note for broader equities. It's just going to be a rockier ride because we've got so many things to work through and that have to come into focus. And those are the items I talked about at the start of my comments.
On a situation like that, where do you guys look as far as 24, 25, 26?
If we're elongating our time horizon to your question, we feel pretty good about equity markets. We still have this perspective that these lower earnings haven't been quite forecasted in the market, and investors got a little bit ahead of their skis in terms of how fast they expect the Fed to cut rates. When you think about what drove that rally in the fourth quarter that Brian covered earlier, that was the pivot. That was when the Fed said they were done raising rates. And the investors immediately started focusing on, well, when's the first cut?
Right.
That was the fuel. And our view is that there are a couple things that come into light here. One is the Fed acknowledged that they made a mistake calling inflation transitory. And they paid a heavy price for it. And in our view, it's very unlikely that they're willing to aggressively cut rates to re-stimulate the economy when inflation is not exactly where they want it to be. We can look at various inflation measures, and we've looked at them with this committee in the past, and they're still all around 3-ish%. Some are a little bit higher, some are a little bit lower, some are lower if you're looking at 1 month, some they're higher if you're looking at a quarterly basis versus a trailing 12 months, but they're not there. So the risk is that they cut rates and they create more economic stimulus, rising stock market, rising asset prices, and inflation doesn't get to the point they want. It's not in check. So it just doesn't make sense for us to think that they're going to be aggressively cutting rates. That's point one. Point two is the government has trillions of dollars of additional debt that has to be financed. And there has to be a higher equilibrium interest rate in the market for that debt to get financed. So all of that means that maybe the base rate for the Fed funds isn't 2% what it was before or in that area. It's probably closer to 3 to 3.25. And that's not what the market's forecasting just yet.
Are you all?
Hey, David, let me. Sorry, go ahead.
Go ahead, Brian.
I was just going to add on to Jim's comments. What that outlook potentially means for the portfolio here in 2024. So I think it means a couple of things. One is maybe we overweight bonds a little bit, particularly in the early part of the year as those earnings estimates on the stock side come down, and as it becomes more clear that the Fed isn't going to be in cutting mode as soon as the market hits thought. We're effectively there. We got a little bit of an overweight to bonds. The other thing that I think it means is to continue to be a bit more exposed to those areas of the market that don't have as stretched of valuations as the Magnificent Seven and technology more broadly. Because if there's choppiness and rates maybe are higher for longer, you don't get those cuts, those lower valuation stocks, in theory, should do better. And then when we get sort of the reacceleration of growth, those companies should be growing their earnings faster than the broader market as well. So that's where we're positioned, is to, we've got a sort of a cheaper valuation on our equity side because we're not as exposed to those top names as the broad benchmarks. We have a little bit of an overweight to those smaller cap names, which look quite attractive on a valuation perspective. So that's what it means, I think, David, from an overall portfolio positioning standpoint, particularly in the early part here of 24.
Okay. Thank you.
Yep.
I have one other quick question. Pre-pandemic, we were, there were a lot of deflationary sort of pressures, and that was, the Fed couldn't get inflation, and we were sort of in that low growth, low inflation. Fed was trying to get inflation and couldn't do it because it couldn't fight sort of these the globalization, productivity, deflationary pressures. Why would we not be headed back towards that sort of same environment now? And it's only a matter of time, a year or two, but before we're going to be back in this same place we were before the pandemic.
So maybe I'll You want to take that, or you want? Okay.
Yeah, I think one of the reasons is the importance of onshoring. So if we look back at the components of what drove inflation or deflation, a lot of it was outsourcing production to areas where labor was very inexpensive. And now, for many reasons, that's reversing. And we see companies onshoring, making sure that production is stable, and either in the United States or areas where their production costs are substantially higher.
Is that and I don't know what sort of data you look at. Is that actually happening? This, I don't know, whatever the globalization is actually reversing?
It is manufacturing, and it's starting with the most critical components of manufacturing. That onshoring trend or theme, it's real, and it's accelerating.
Okay.
Landon, I think there's reasons to think to support that view that inflation is going to come back down to what it was pre-pandemic, and there's reasons to think that we're sort of at a structurally higher place right now, and likely to be here for the foreseeable future. I think the onshoring and the stuff that Jim talked about is one. The other thing is that the fiscal spending in Washington is bonkers. It's out of control, and there seems to be no appetite or ability to bring the spending back down to reasonable levels that's highly inflationary. On the flip side, you look at it from a more sort of secular perspective, sort of longer term. You have competing, on the other side of the balance, you have aging demographics in this country that bodes well for things like healthcare, but it doesn't bode well for, other non-healthcare consumption. So that's sort of disinflationary. The other thing too, and this evolves over years and decades, is the disinflation that comes through from technology. Now AI, in all likelihood, will be highly disinflationary, but that's likely to play out over a long period of time. So I think what you might see is sort of higher levels of inflation for the foreseeable future than at some point, and it could be 10, 15 years down the road. I think you might see inflation dip back down to what it was, but markets are not necessarily discounting what's going to happen 10 and 15 years down the road. We're trying to figure out what's going to happen 10 and 15 months down the road.
That's a great question, but it's extraordinarily complicated, and we have China's GDP growth is really struggling. They're dealing with a demographic issue that Brian touched on, and they represent about 18% of global GDP. So there are many, many moving parts to that inflation number expectation.
Thanks.
We go back to the portfolio. Stacy, maybe slide 34 is a good place to start. I think it's 34. Sorry. One more, right there. So here's our returns on the left-hand side for the go back one. Page 34, slide 34. Yep, right there. Net of all fees, we're up 9.5% in the fourth quarter. Just under 10% total return, 9.4 for the benchmark, so a little bit of outperformance there. We'll talk more about it in a couple of minutes. For the full year, for the full calendar year 2023, 15.2 behind the benchmark, As we've talked about in previous meetings, a big chunk of that has been the fact that we're underweight those Magnificent Seven names and the impact that they've had on broad market returns. If you were simply replace, and I'm not suggesting we do this, but I just want to provide the context and provide some illustration on the challenges of managing to that benchmark. If you were to replace the cap-weighted S&P and the benchmark with the equal-weighted S&P, the outperformance for 2023 would have been massive. Again, I'm not suggesting that we do that, but it is true that, and we've talked about this all year, that those seven names, those biggest technology names, drove much of the performance during 2023. And we've seen that reversal, as I mentioned in my opening remarks in the fourth quarter. That's why you see outperformance for the fourth quarter. The other, I'll make two other comments here. One is that although we're well below the benchmark, 15.2% return once we get the returns from other public pension funds around the country, I would suspect that return that we're showing there is going to be in the top third or top quarter of returns earned by public retirement systems around the country. We'll provide that information once it becomes available, but the initial results that we've seen would put this return, right at about the top quartile. The second thing I will say is because this meeting happens so early, we get a little bit of a delay in some of the reporting on the alternative side, and in particular on the real estate side that we have. And so we've got some stale numbers in there that still include what happened in 2022, which was a pretty big drawdown, particularly on the office side and some of the investments we had there. And so that is, in some sense, is distorting that return relative to the benchmark. But for all intents and purposes, 2023, really good year, 15% return, well in excess of the actuarial return assumption. Now I know, we look at plan years and not calendar years, but I would say that this plan year, which would include the fourth quarter and or the second half of 2023 and then the first half of 2024, is shaping up to be a pretty good one, and hopefully will continue to be in excess of that actuarial return assumption. Lastly, on this slide, we started calendar year 23 at about 181.7 million. We ended at 188.1. So we saw some asset growth, and that even is after the $20 million roughly in benefits and plan expenses that were paid during 23. So good year. We as you know, are expecting to see returns in excess of the benchmark. We've seen that a little bit in the fourth quarter, and I talked about how we're positioned to be a little bit overweight fixed income, a little bit overweight those areas of the market that are cheaper from a valuation perspective. Stacy, if we can go to the next slide 35. Here's a sort of a quick look at the asset allocation. You see we're underweight stocks by about 1%, not any significant allocation deviation, but reasonably in line with sort of the outlook that Jim talked about earlier. We may increase that underweight to stocks, but it's well within the ranges that are specified in the investment policy statement. Next slide, if I could, Stacy, 36. Here's how our portfolio, in terms of our exposures, stack up relative to the benchmark. In sort of the top half of this page, in the middle there, you'll see underweight, neutral, overweight. The two that we have on in the portfolio, and I alluded to this earlier, we're overweight small cap stocks, we're overweight international, those areas of the market that didn't do as well as the large cap U.S. stock market. That helped in the fourth quarter. It was a drag on performance during the full year, but we expect the big cap stocks whose valuations are stretched, maybe to underperform the broad market, and that's the way we're positioned. And we saw that, as Jim mentioned yesterday, Google reporting. I think we were down 6 or 7% on Google yesterday. Microsoft was in line. We've got more big, and Tesla was a struggle as well. We've got more big tech earnings after the close today. I think it's Apple, Amazon reports, and then I think Meta reports as well. So we'll see what those reports look like, but that's how we're positioned in the overall portfolio. I think even though we expect sort of these areas of the market that maybe didn't do as well in 23 as the big cap tech, we expect to be overweight those names. Our plan here is, as benefit payments are required, we're probably going to pull back a little bit on that overweight, but we still expect to be overweight those areas of the markets that didn't keep up. Stacy, maybe slide 38. 2 slides ahead. One more. There we go.
So, Brian, just
the attribution.
Brian, just a quick question. Just a little bit more of your thoughts around small cap and international. It has been a long time since either one of those has outperformed U.S. large cap. I think it's like a decade now. So you think the sort of the catalysts are there that it's going to work now?
Well, the catalysts have always been there. And you're right. You're absolutely right. They haven't worked. And it's really since coming out of the global financial crisis that large cap stocks in the United States have been the absolute best place in the global equity markets to be. So why do we think we'll take each of them on their own? Why do we think small caps are maybe going to do better, and then why do we think international is maybe going to do better? So first, small caps valuations are cheap relative to large caps, so we haven't had the multiple expansion in the small cap side that we have had in the big cap tech side. So from a historical perspective, we're at relative valuations in the small cap space that are 20, 25 years. We haven't seen the relative valuation in small cap for 20 or 25 years. Secondly, with the expectation that corporate earnings growth is going to reaccelerate in the second half of the year, the growth rate from smaller companies should be stronger than we see in the large cap space. So those two things combined are why we think small caps going to outperform. On the international side, you've got a couple of things. One is when the Fed starts to cut interest rates, we should see a decline in the value of the dollar relative to other major currencies. The thing that has made the dollar so strong here during COVID and beyond is that the Fed was quite aggressive in hiking interest rates, and the biggest impact in determining the direction of currencies is relative interest rate policies among countries. So we expect when the Fed starts cutting that the dollar should roll over and these other foreign currencies should rally as a result of that. That would be good for any assets that are, any investments we have that are domiciled overseas and are valued in other currencies. The second thing is Japan looks really attractive to us. There's been a number of changes related to the corporate culture and shareholder rights and values and those sorts of things that we've seen the Japanese equity market in particular at levels that we haven't seen in multiple decades. Now, it doesn't mean they're outperforming necessarily what's going on in the U.S., but we think because those valuations look more attractive than the valuations here in the U.S., and there seems to be this sustained change in culture that this area of the market can rally as well and do better than the U.S. So high level, there's obviously a lot that goes into it, but those are kind of why we're positioned the way we are. Um, 38 here is a look at the attribution for the quarter. We outperformed by about 10 basis points. This is on a gross to fee basis because that's the way our system works. But all of the outperformance coming through from the selection effect. So the managers we had in place did particularly well during the fourth quarter. I'll just call your attention to the alternatives line, and this just kind of touches on the comment I made earlier because of the slowness of current valuations on some of these investments. If we were to strip that out, we would have outperformed probably by 30 or 40 basis points in the quarter. So when we get more current and recent valuations, I think you'll likely see the performance of the overall portfolio show up better than the 10% outperformance, 10 basis point outperformance that we show in the fourth quarter. Lastly, let me just touch on the manager side on page 49. In aggregate, they all have done quite well. We did make some changes in the fourth quarter, so I want to touch on some of those. Stacy, page 49, if you would, please. Thank you. Okay, here we go. So we're showing lots of different time periods here. Let me just kind of touch on the changes that we made during the quarter. We restructured the small cap component to the portfolio. As this board may recall, we had two active managers in the small cap space. One was Rice Hall James, which we've had for years, and the second was Delaware, which is a small cap value manager, Rice Hall James being a growth-oriented manager in the small cap space. We've got a little bit of a stub position that you'll see there on Delaware small value, but you see their assets are down to $2,500. So we've terminated both of those managers, and we've put the assets with Earnest Partners, which is more of a balanced approach in small cap. Has a little bit of growth, has a little bit of value. We did this for a couple of reasons. Number one is it simplifies the program. We go from two managers down to one. Secondly, we have had a number of discussions with this board over the years about the performance of Rice Hall James in particular. We just became increasingly less confident in their ability to generate excess returns in multiple different market environments. They've struggled a bit of late. We did capture some of the relative outperformance that both of these managers generated in the fourth quarter. We just felt it was a good time to simplify and move to a manager that we have a bit more confidence in here. And you can see in the second half of December, they've outperformed. They've doubled the return in the index, which is good. But obviously, make an assessment on a 2-week period. So that's the most significant change that we made to the portfolio in the fourth quarter. The other managers we have in place, they have all done, quite well. See Aristotle, our active large cap value manager for the quarter, almost 15% return versus their benchmark of 950. That puts them up almost 10 percentage points for the full year relative to the benchmark. We're up about 20.5% versus 11.5% for the index. Harding and Loevner down on the international equity side, generating, again, very strong fourth quarter returns, almost 12.5% versus their benchmark of less than 10. Puts us up for the full year by about 60 basis points, over 16%, 15.5% for the index. Capital Group has been, they've generated decent absolute returns, particularly over the last, quarter and 12 months, but they're lagging. This is an area that Jim and I are looking at. We may have something to report back to the committee the next meeting we have. But it's something that we're looking at and wanting to see if there's, something else that maybe makes more sense. And I would say that it would be very, very similar to the rationale of the changes we made in the small cap side. Maybe let's simplify the program and maybe, get something that we have a bit more confidence. Lastly, if I can just kind of, Stacy, the next slide here, we've got, the bond managers that we have in the portfolio, basically two double line and Luma sales. You'll recall we had BlackRock for a long time in this portfolio. And we made the switch to move out of BlackRock into Luma sales. We gave double line a little bit more money as well. But that move has been quite good, as you can see in the Loomis row there. For the quarter, they were up 720 versus, basically 6.5% for the broad bond market. And since they were put in place, a 3.5% return versus less than 2%. So a lot of the changes that we've been making in the portfolio have been working. We talked about how we're positioned, the reason for it. Benefit payments, we're probably going to continue to reduce a little bit the small cap overweight, but we're going to continue to be overweight that area of the market for the reasons we discussed. And then a lot of the new active managers in particular that we put in have done quite well. So with that, let me just kind of provide just a quick snapshot of January. I forgot I had that. It's been a little bit choppy in January. S&P was up 1.5%, a little bit more than 1.5%. Small cap stocks have been down about 3.5% or so. Markets outside the U.S. were slightly positive. Nothing to get excited about. And bonds were pretty much flat during the quarter. As we look at our performance versus the benchmark, our portfolio and the benchmark is going to be pretty close to zero for the month of January. So we'll see what the February looks like. It looked like the futures were pretty strong this morning. Interest rates continue to come down this morning. And I think the focus now that the Fed met yesterday and came out with their report, focus will continue to be on corporate earnings and relative to estimates, and then the guidance for the second half of the year. That'll give us a sense on sort of market direction here in the short run. So with that, I'll stop and see if there's any questions.
I don't hear any questions.
Okay.
So thanks, Brian and Jim.
You bet.
All right, well, I guess I'll jump up next. Stacy, if we could please first show the document is COP funded status reconciliation. I'll just give a quick update there, and just want to say good morning to everybody. And as Brian and Jim said, appreciate the flexibility offered here to attend the board meeting. Unfortunately, I've probably best for all that I'm sequestered here in my office in Connecticut because I've picked up quite a good head cold. So if we could just jump to the third page, I will just highlight an update for the consolidated plan. Then you can scroll down a little bit further so we see from starting with June 30th. Perfect. So this here shows really that performance, some of which Brian's alluded to in the impact of the strong investment return, specifically in the fourth quarter. If we look at that bottom grid there for the period September 30th through December 31st, you're going to see market value of assets be roughly a little bit different than what Brian showed. We do hold some transitionary cash as payments are made as we go through month end, month beginnings. Sometimes those balances are slightly off that the actuarial team has access to. But all that said, you will see, based on an estimated investment return impact of almost $10 million to the combined portfolio in the fourth quarter, definitely assisted in bringing the projected valuation back up to almost 69%, so closing around 68.75%. So that's slightly off where we closed the last fiscal year, but again, as these are estimates, just kind of looking at high-level transactionals, but headed back anytime we can outperform distributions and redemptions, that's obviously a great thing, as we've talked about with regards to the combined portfolio. The other thing I just wanted to mention and or ask, I know Flora is in the room, so I know last year, just about at this time, I think, right at the beginning of February, the city made the decision to fund the entire fiscal year contribution. I didn't know if there was a plan to do the same for this year, because I also just wanted to reflect that this doesn't show contributions being made yet, as those haven't been received. But yeah, as a reminder, the expected combined contribution is around $8.4 million, and was just curious to see if there had been timing finalized for that.
We'll do that, yep, this month.
Perfect. All right. So I will I'll give a heads up to our internal teams, and that'll certainly help the numbers, hopefully, when we regroup at the end of this quarter. All right. So Stacy, if you will, I'll just give a couple of additional quick updates in my other document, the John Hancock 2124 presentation. And we probably can jump to slide 5 when that comes up. And you know, really just as I'd like to take the opportunity to give a couple of additional updates to the board throughout the year. One of the things you'll see here, and I think I've showed it in the past, is we know, if you want to slide back to slide 5, you know, again, primarily this is a retirement system, right, to pay benefits, and the vast majority of individuals are retired, have stopped working, are receiving the great benefits that the city has provided in past years. We do offer additional education, assistance, awareness. We do see some interaction from members of the program. Primarily, they're just getting their benefit payments. But for those folks that may come out to the website, especially when they're looking to model their benefit payments and start that process, they'll be reminded that there's always a host of financial wellness services, webinars, et cetera, that are available. So we have a full calendar of events. Individuals can sign up at any point and get reminders if they are looking for a little assistance throughout the year. But why don't we jump ahead, and I'll just hit a couple of the system statistics. So if we go to slide 9, make a couple of comments here on fire and police. So as Derek mentioned at the opening of the meeting, the fire and police plan, we're down to just one active. Vast majority of individuals are in pay. That's reflected by those that we're labeled here as retirees. And then the term vested benefits are just individuals who have not yet started their payments. But you know, if you do the quick math, 94% of this population is in pay. The only one active individual is, I think, targeted to probably at some point in the near future we'll see that status transition. Yeah, if we go to the next slide, again, I commented just, obviously there's no new participants, contributions haven't come in yet. We'll reflect those here in the first quarter reporting for 2024. 2024, and the monthly payment amounts just remain very consistent based off of the population. We can skip through slide 11. That just shows that one active individual having over 25 years of service. And then finally, for fire and police on slide 12 here, this just looks at some of the other activity from the fourth quarter. You know, you'll see, unfortunately, there were 7 individuals that were reported back as deceased and had benefits ending. But, you know, as we like to point out, look at the length of time that these individuals were able to receive benefits from the city, between 10 and 35 years. So, you know, great benefit that has been provided to them. We did see some activity in the top section. 5 individuals were notified and probably will start the process of looking to start payments. And we did in fact start or modify one distribution benefit payment to a spouse, and then 2 new individuals began receiving payments. So again, we're going to see that remaining 6% of the plan not pay quickly change here as we continue forward. If we go forward, slide 13, same look for the supplemental system. Still a handful of actives here, but again, decreasing over time. And again, vast majority of individuals are receiving benefits. So just around 4.5% of the total population is not currently receiving a benefit from the system. All of the active individuals are over age 60. And if we move ahead, we see similar activity on slide 14 that we saw in the fire and police from just consistent payment of distributions, you know, paying out almost 1,000 benefit checks, $1.8 million in distributions. And then on the next slide, again, the remaining individuals, significant amount of years of service, and we would be expecting their statuses to change soon. Finally, on page 16, there's limited activity from the last quarter. There were 2 reported deaths. Again, both individuals had been receiving benefit payments for over 20 years, and we saw a couple of other individuals start the retirement process. So we'll see some changes there coming in Q1. And then finally, for me, in the last section, if we want to jump forward to page 19, again, just to provide the consistent disclosure on overall fees. And again, I think the board has become familiar with this, but very consistent. The all-in, if you go to the far right, the all-in expense is very low at 43.5 basis points on total assets. The investment management fees came down. I think we talked a little bit about this last year, came down significantly. I think it's as a reflection of Morgan Stanley Greystone taking advantage of investment opportunities and where the categories are that a lot of the assets are in. But investment management is now just around 27 basis points. So a very low figure when you think about areas to invest in across whether it be corporate, institutional, municipality, or even individual investing. And then the next 2 pages just kind of break that out based on looking at annualized projections based on where assets are held on how we get to those numbers. And that is my update for this morning. So just a brief update, but if there's any questions, happy to take those. All right.
Thank you, Tom.
Thank you.
Tom, one question, please. You mentioned that you had opportunities to educate participants. Is that marketed in any way to those participants, either through the city or through John Hancock?
Yeah, I mean, so right now for us, for any individual who actually has provided their email address online, and we have a good number of them. I don't have the number right in front of me, but we do proactively send messaging out, and we would be promoting, for one thing, the webinar schedule that I showed on the different items that are available.
Okay.
And I know in past years, the city has done some things with retirees, I think because the population has gotten so small. We haven't partnered with the city to do anything in person, but we do have that opportunity if there were sessions that wanted to be offered out where we could provide an educator to help either walk individuals through the process. Again, the population's pretty small, or if there was other needs related to the pension system we could help with.
All right, thank you.
Sure.
All right, thanks again. Thanks, Greystone. We will see you next quarter. And if there's nothing else to discuss, I think we can adjourn. Or do I need a motion to adjourn?
Make a motion.
All in favor? We're done.
Good job.
Thanks, everyone.